again, and this afternoon it's my privilege and honor to be talking with a longtime friend of mine, Mark Brechbill, CPA, right here in Stuart, Florida. Mark and I have known each other for more decades than I can.
Way too
long. Yes, yes, yes. We have crossed paths many ways. We are both members of the Martin County Business Exchange, which is one way that we keep in touch with each other. And of course, we talk from time to time about taxes and stocks. So let's start out. Mark, tell our friends about Mark Brechbill.
Got an accounting degree undergraduate from Western Illinois University. Interesting fact about Western Illinois University, they're the only other university other than West Point that is allowed to use the leathernecks as a school
symbol.
Okay,
yeah. All right. Well,
so that's it, which made a big difference when you
sure.
were coming back from Vietnam or whatever back in 72 and 73. And so I worked early in my career. I was in public accounting. I was with Arthur Andersen. I was with McGladrey for a while, and then while I was with them, I specialized in the banking area, and after a period of time, went to work as a banker. Chief financial officer of a bank, and eventually I was starting banks from scratch.
And where was this?
This was, some of it was in Illinois, originally around Peoria, Illinois, and then I was at a bank in Pekin, Illinois. And but the banks, I came to Florida to work for a large bank in Palm Beach County, and I was their CFO. They were about $1 billion, about a $750 million bank at the time. This was back in 1982 or so, and so that's where I got into really heavy into banking. And I, even though I'm a CPA now, I've been practicing as a CPA for a number of years now, and I'm still practicing, Merle, because I can't get it right. So I'm working on it.
Some people figure out how to retire, but you haven't.
No. Still working on it. Still working on it.
I know. Now you got your undergraduate degree in accounting. Your major was accounting, and this was in Illinois. And when did you become a CPA in Florida?
In 1983.
1983. You had to pass the credential requirements for Florida.
Well, yeah. What I ended up having to do is to get licensed in Florida. I had to get licensed in. Well, I had passed the exam already, and I passed the exam in 78. So, but I wasn't working as a CPA in public accounting where I was signing reports. I was working in public accounting for Arthur Andersen and McGladrey, but I didn't have to sign reports. So I never got to the point that I got my license in Illinois. So I had to go back and get my license in Illinois, and then reciprocity, I could get it in Florida here.
Okay.
And I'm a testament to the truth that anybody can get licensed in Florida, I guess, as a CPA
if you're licensed somewhere else.
Because they let me in.
All right, you're in private practice now, and you have been for a number of years, and you do both individual and corporate work.
Yes, yeah,
okay,
and
right.
A lot of what I do right now is consulting.
Okay.
A lot of tax consulting, but a lot of business consulting, a lot of asset protection work. Frankly, as the economy ebbs and flows, and especially when it ebbs, all of a sudden lawsuits and other things become a better source of income, right?
Yes,
and
yes.
so one of the things I've worked a long time on is helping my clients avoid that situation. I think it's so unfair. I know how hard small business works because I am small business myself, and I know how hard those people work. And it would be such a shame for them to spend 30, 40, 50 years of their life in the business and then due to some stupid mistake, lose it all. Now,
yes.
I'm not saying people shouldn't pay for their mistakes, but should the payment be losing everything?
Yeah,
should it be everything? And so I do a lot of that. I do a lot of tax planning, and I have expertise in certain areas: homeowners associations, country clubs, partnerships, LLCs in particular, taxes partnerships, and things like that. So I deal with the IRS on a regular basis, and it's an interesting process. But the time that I spent in banking, I really look back on that. And as far as really being part of the cutting edge, or as a friend of mine used to call it, the bleeding edge of finance, it is the bankers.
Those are the bankers.
They usually are making the rules as they go.
Right.
That whether those are accounting rules or financial rules or whatever, and it really is a profession where you're on the ground floor learning what's going on. And we were doing things back in the days where we were doing hedging and we were doing all kinds of financial transactions. At most of the banks that I worked at, we were not huge banks, so I was the resident economist.
Oh, okay. Taking from my book, right?
Yeah,
Okay,
yeah, yeah.
okay.
Literally taking from your book. So so that was so it was fun. Not only because a lot of what we did centered around our budgets, and our budgets, as you know, Merle, with banks and financial institutions, spreads and managing interest rates and interest rate spreads is a big deal. And so having and trying to project where those interest rates are going to be, because depending upon how the bank has structured itself, it could be hurt or helped by high interest rates or low interest rates. And that's the thing that people don't understand. People think, well, banks, if the interest rates go up, that's what the banks want. No, not necessarily. If they have loans that the interest rate on the loan is fixed and their deposit based costs are going
Going
up,
up,
they're losing
they're in a
money
squeeze.
no
Yes.
matter how, no matter what happens. Is they so it's all about how they're structured and how they're managed. So and I did a lot of that. I actually, one of the things I was kind of proud of is I actually spoke at the American Bankers Association National Conference on on what was called gap analysis, which was the management of interest rates for small community banks or for medium and community banks. So I did a session on gap analysis for the community bankers, and there was somebody from Chase or somebody that was doing the presentation for the money center banks at the time. But it was interesting. That was something I really kind of enjoyed, and it's helped me learn a lot about interest rates and what's going on and taxes and what we're doing there, because that's profits make a difference. So
Well, we've just finished the tax season for 2026. And did we benefit from the big, new, beautiful bill?
well, first of all, I'm not sure the tax seasons are ever over.
Oh, right.
So
In your
so
business, they're never over.
they're
Right.
never over. They just keep going and going and going. But the one big beautiful bill, believe it or not, did did produce some positive results for almost everybody. Um, and I'm just gonna say it flat out, because this is what. So I'm going to talk about, when I answer your question, or when I'm talking about things, I'm going to talk about what happened. Whether you like the person that pushed them or not, um, they got implemented and they've done a lot of good things. And so from that standpoint, yes, taxpayers did end up coming out better, and frankly, better than high income taxpayers.
Well, that was the promotion of it, that this
It,
was going to help
it,
the
it
middle
is.
income people, and
It,
you, in your experience, you found that it did.
yeah. For example, I'll give you a good example. They, the administration, when they passed the bill, originally, there was going to be a provision in there, no tax on Social Security. Well, they it got billed as no tax on Social Security. What it actually was a credit, um, that it was a $6,000 credit for people that were collecting Social Security, that allowed them to offset their taxes, and and but it phased out. So if you made over, I think it was like $90,000, you lost that. So anybody who made over $90,000 in effect was paying tax on their Social Security, just like they used to pay tax under the same provisions. None of that changed. It
Right.
was just this credit got bigger or smaller depending upon what your income was. And that was probably fair. I mean, when you look at a lot of the things that were in the tax code, and the one that's not in there that I'm disappointed about, that was in there and is not in there now, is something that probably, if you've got any listeners out of New York or Connecticut, Illinois, California, New Jersey, they're going to hate me for saying this, but the the laws previously, and if you really think about this, is ingenious that somebody really caught this. If if you're being given a deduction on your tax return for your state
Income
and
taxes.
local taxes,
Taxes.
state income taxes, and you live in a high income tax state, right?
Right.
you're getting a deduction on that for that. That's reducing your taxes on your tax return,
Right.
and I'm not getting that reduction if
No.
I'm in another state. So that was
It's
really,
discriminatory.
it was,
Yeah,
and
right.
it really was unfair because it was basically targeting these other states were basically targeting states like Florida that don't have an income tax, and we were paying portions of the taxes for people in New Jersey and
Right.
California and all that.
You and I had to pay taxes
Right,
because some people in New Jersey were getting a tax break.
right. And in the original bill that was passed when Trump first went into office, it capped that at $10,000. So basically it took that all away. People ended up taking the standard deduction, and it took all of that away. But I understand politics. But it doesn't make good tax law. So the one big beautiful bill, we're back to being penalized. And if you're in Florida or Texas or some of these places where you're not paying the taxes, Nevada, whatever, you need to scream at your politician to
Right.
hold the ground because it's not fair that you're paying taxes for those people that are spending money in California or in New York or New Jersey.
Now
Which, by the way, New Jersey is the highest.
that's why I
People's,
mentioned New Jersey.
that's why I keep mentioning New Jersey. You people in New Jersey need to talk to somebody
Well, yeah,
because
you're paying too much.
and if you either need to talk to somebody like myself or Merle so you can understand the economics of what's happening, or both Merle and I have a friend named Griff who's a psychologist. You should talk to a
Give you mental health
psychiatrist. You can talk to him,
therapy.
and he'll help you get through it. But
Maybe I should interview Griff sometime.
yeah, you should. That would be good. So
the mental health of economics here.
that's right, and it does. It takes a lot of it when you're dealing with some of the stuff. So the one big beautiful bill, it did accomplish in a lot of different areas. It accomplished some equity, and like I said, people generally got deductions or got a reduction in their taxes. Now, the thing is though, you I have people always say, "Oh, did you get any money back? Did you get money back with your taxes?" Well, the fact is, you're not going to get money back with your taxes unless you paid it.
Paid in, yes.
And a lot of people don't realize that.
Right.
I can get everybody a refund. Just let me do your estimated taxes, and then you'll
Right,
have paid
right.
in a ton. But keep in mind,
You've got to have something to refund.
right? Yeah, and keep in mind that the IRS does not pay interest. Which so if you overpay, that's just sitting there, and you're not getting paid on it. You know what's interesting about that though, Merlin? I've wondered why, from a tax process standpoint, we make estimated payments, and we don't get any kind of interest on
Well,
those.
we sure don't.
So we don't.
I do
right,
it quarterly.
right.
Yeah,
So you do it quarterly,
I pay
and
quarterly,
you
yes.
pay as little as you can get away with, right, to avoid penalties
Which
when you file.
unfortunately is not that little, but
Right. So why don't they just let us overpay our taxes, but pay us a small interest rate? It's government money, so you got government interest rates, right? Now the government's got money to work with. The government and taxes are all about cash flow. They're not about income. They're about cash flow. The government needs your cash flow. That's why you have to pay your taxes in advance instead of paying them
Yes.
when you do your return. You've already supposed to have paid in 90% of the taxes you owe. You're supposed to have paid that in by the time you file your return on an equal quarterly basis.
Or if you're not, then they charge you interest.
Then they charge you interest, right?
It's not really-
So if you think about it, we spend all this time and money, and we probably talk about it a little bit later, but we've got we got a debt that's potentially rising. There's interest costs
It's
associated.
not potential. It is rising.
All right. Well, I was being generous, but we got a debt that's going up, and we've got to fund that debt, and so we're selling bonds. Well, why don't we just sell bonds to the taxpayer by letting them overpay their taxes, and bingo, right?
Right.
It's like what's his name, the the guy from Nebraska. He's see, as soon as you retire, they forget about you, Merle. So
Yeah, they do.
Buffett.
Warren Buffett. Yeah.
like
the
Buffett
Oracle of Omaha.
Right.
Okay.
So Buffett said, "Oh, my secretary is paying is paying a higher tax rate than I am."
Right.
Well, yeah, a higher tax rate maybe, but come on, yeah, there's no way you're paying hundreds of millions of dollars probably in taxes, and you're paying your secretary's paying $23,000 or something. But anyway, so then he would actually be right because we would leave that money in there. It'd be a great investment plan,
Yes.
right? And you're going to have to eventually pay it anyway. So you would now the government would give up those penalties, and they love that. I mean, that's
They
probably
like the
why they don't do it
penalties,
because they
right?
like the penalties,
Right.
and they're already getting money coming in here, so they'll just they're let you borrow it and then charge
But
you penalties.
if I could pay an extra amount on my taxes and earn
Right,
interest on that, that would save me from having to go and buy a bond or
right,
something,
and you
right?
could avoid. Then you could overpay your estimated payments because you're really just making an investment,
Right.
and you wouldn't have penalties
I'd never
when
have
you
it.
file your
Right.
return.
I know.
And that those are becoming more of an issue now because of the shape that the IRS is in. And I know we're going to talk about that a little bit in terms of what kind of shape the IRS is in.
Well, any other implications of the big beautiful bill that we need to talk about?
Well, yeah, there's a couple things. Like I said, in general, it was positive for taxpayers, and particularly, I won't say necessarily low income. I'm just going to say working income taxpayers. Um, a lot of those people that are paying some tax, it helped them out quite a bit. It reduced what they paid. They have kids. I mean, the whole idea with $1,000 on babies that you've got, that's starting a kid off in effect what should be a retirement account down the road, gives an avenue for grandparents and parents to fund them. That was a great
I thought that was interesting. That's
yeah,
an interesting
yeah.
concept.
Again, all of these things have a goal in mind, and that's what. And a lot of people that aren't financial people don't see that goal because it's not obvious. But I know on a regular basis, since we work with this on a regular basis, you can really see how smart it is when you see how they're targeting,
Hmm.
and what he's doing with that. I think the last time we talked on a show or we're doing some stuff, we talked about the tariffs, and at the time, what we were talking about is that the tariffs weren't being used in the conventional manner. So a lot of people were upset with tariffs because they're free trade people and they saw this as a reduction in free trade. But as we discussed, the tariffs were being used by Trump to target individual countries whose government was giving them an unfair advantage on production.
They weren't practicing free trade.
Right, right. They weren't practicing free trade, and that's one thing I always like to. I'm a conservative guy, and I admit that wholly. But one of the things that, and I believe in free enterprise. But one of the things I do believe in is the basic economic principle that if you don't have a free market, if you don't have equal strength buyers and sellers, you're not going to get a fair price,
No,
an
you're not.
equilibrium price,
Right.
right? And so,
Free trade works if both participants
right.
practice the principles of free trade. But if one side has tariffs or quotas or barriers, the other side doesn't, then we don't have free trade, and it's hard to advocate.
Right. And
Um,
and if one of the parties is so large that they can just dictate the terms,
right.
and that's what we have in many industries. I mean,
Yeah.
you look at the S&P 500, and most of those companies on the S&P 500 have no serious competition.
True.
They are the biggest of
Right.
their industry, and so they need to be regulated. People. I mean, I'm a Republican, and my Republican colleagues need to get their act together because I almost said something else, but they need to get their act together because they're trying to protect businesses that shouldn't be protected because they're monopolies. So let them compete. If they compete and they fail, that's fine. But once they've got to the point that they have no competition, then whatever they do is not going to be fair to the consumer because of where
And
they're at.
on that point, I was very sad to see the demise of Spirit Airlines. And they attempted to merge with another airline back 3 years ago or whatever. And that was denied because we were, quote, preserving competition.
Right.
They forget that you have to preserve the competitors if
That's
you're
right.
going to have
That's right.
competition.
That's right.
If you don't preserve the competitors, they're not going to have competition. But
That's
so, and unfortunately, the demise of Spirit Airlines affected over 4,000 people working here in Florida.
yeah.
So it hit kind of close to
and
home.
and it made other entities less
Let's compare.
competitive.
Yes,
They had
yes,
more of a dominance in their market,
yes, yes.
and so and then all of that just flows through. So now you get a entity that's maybe got control of a market or a particular market. Maybe they're controlling the Northeast airports or the whatever, and 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 you've got this situation where uh,
They are
Now,
monopolies in that market.
right, and they
Yeah.
don't have to negotiate with
Yeah.
their unions,
No.
so they end up overpaying, and then all of a sudden, what happens? They overpay, they go broke. How many airlines have filed bankruptcy? I mean, that's just pretty. And the reason they do it is they negotiate an agreement with their pilots and their unions. That agreement isn't with, but they can get away with it because for a while they can pass that cost along.
On.
And then as soon as they have competition, they can't. And then when they don't, they can't pay the pensions to their employees, who then have to file with the
And the pensions are unfunded.
Yep,
The
and
pensions go
exactly,
unfunded.
and
Yeah.
that pension is supported by us in the federal government,
Yes.
so the taxpayer ultimately bails them out. And so, that's the
And
kind
we've
of
seen
thing.
that several times. There's hardly
All
any
the time.
airline that hasn't declared bankruptcy at one
Exactly,
time or another.
exactly. So it's crazy.
Well, I know another thing that you're concerned about, another issue I should say, is the IRS and their staffing. And you deal with them, and it's hard to get an answer, isn't it?
Yes, and I'm gonna your show. You're gonna break the news to the world here.
Okay, all right.
I'm gonna
Flash. Okay.
flash,
Okay.
and this is. I think everybody really needs to know what's going on. The Right now, the IRS didn't work for 2.5 years. So
No.
no.
Say it isn't so.
And before, you could argue whether
But
they
I pay
were
taxes.
right, but they don't know it.
Oh, they don't know it.
I mean, it really is. It's gotten to the point. So what happened is during COVID. Now think about this a minute. During COVID, some businesses they sent their employees home, right?
Mhm.
But they still functioned at some level. They may not have
Yes.
been as efficient. They may have been more efficient, but they functioned at some level. But the Internal Revenue Service can't send their employees home. All of that data would be subject to being stolen, right? You can't put enough security in somebody's individual
Right.
house to protect from all of that being hacked. So they couldn't even answer phone calls because they couldn't even access the system. So for
Wow.
2.5 years, we paid them to sit at home and do
And
absolutely nothing. Now, that would be bad enough, but that they were already behind, right? Their computer systems were already
And
archaic.
they got more behind her.
You got more behind her. And that's exactly what's happening. So now we've got the IRS asking for tax returns from 2017 and 2018. Keep in mind, the IRS doesn't keep any of this stuff. And at one location during COVID, right after COVID in 21, 22. So a lot of this stuff is spilling into 21, 22, and 23. It was a disaster. And they're still having problems. The answer is not more employees. And I'm not saying that because of my love for the IRS or my hatred for the IRS, because it's neither one of those things. If we brought in a bunch of people into the IRS right now, it takes 2 years to train them.
Mm-hmm.
Now, you know how they get trained? You take one person off of a job and team them up. So now we've got two people doing the job of one person, right? For 2 years. So the only way you're going to solve this problem is there's only really a couple ways you can solve this problem. One is to just write all that stuff off.
Or how about artificial intelligence? Is that going to help us?
Well, I've already got that, and it hasn't helped me at all. But, my intelligence is always artificial. But yes, I mean, if they could improve their computer systems, but right now their computer systems are so atrocious. And we found during COVID some interesting things. For example, if you file your return electronically, which now you have to do, this year the IRS said you have to file and you have to pay electronically. Now, that's probably unconstitutional, but they've said that that's the case. And they're saying that if you don't, it can take up to a year for your tax return to get processed and up to a year for you to get a refund. So now they put it, but you would think if you filed electronically and you're having your payment done electronically and the payment came out of your bank account, that the IRS would have all the information on your return.
Wrong.
No, right. Because what happens is that your payment and your tax return don't get posted to your IRS account until they're both there and they've cleared the both. So now what's happened is, in some cases, the IRS has taken payments that were designed to go to 2024, and they were supposed to go to 2025. Maybe there were carryovers and go into 2025. Well, they've taken that and they show that you have a liability back from 2020 because they didn't post the payments yet, or from before. And they take that money and apply it there. So now you're expecting money to go to 2025 to pay your taxes, and it's not there.
Oh goodness.
And so and this is a horrendous problem. and because nobody is sure. And the IRS and the government talks about what's called the tax gap, and what that is what the IRS thinks you owe, and the emphasis here is on thinks. It's the difference between what the IRS thinks you owe and what you actually owe. And the IRS thinks that that's a huge number and that you owe. In reality, it's not, because it's penalties that were levied incorrectly.
It's a bookkeeping problem.
It's a bookkeeping problem, exactly.
Yeah.
And so now, how do you get through all of that? You've got people that really aren't trained. Most of the people, there's the same number of employees pretty much, but many of them are within 2 years. They're brand new.
Mhm.
Some of the old timers retired.
Yes.
They saw this coming and they didn't want to deal with it.
Get out while the getting's good.
Get out while the getting's good. So now that's the issue. This thing is, and we talk all the time. It's all about cash flow, right?
Yes.
Taxes are not about the amount. It's about how much cash flow they get out of you and when. That's why under the Johnson administration, he was smart enough to figure that out. He instituted withholding because he knew he wasn't going to wait until the next April to get the cash. He had all these programs he wanted to fund. He wanted the cash now.
That's a great society.
You can't have a great society without cash, right? Without money.
Right.
So what happens is they've got all of this, they are not going to be able to collect the cash. They may be able to report the taxes and the budget may look great, but if they can't collect the money because they're wrong on what they've posted or they're wrong on what they've got to spend, and they're not collecting that money, then it doesn't make any difference whether we had $1 trillion in taxes paid or 100 million. If it's how much cash actually came in, and that's why I say it's important. The information or the issue relative to paying taxes on overpayments would make so much sense because they need the cash. But so here we have this tax gap problem that the IRS thinks exists. It doesn't. When they hire all these people, they're going to find out it doesn't. And now what do they do? And how do you solve the problem? Because you can't figure out what the issue really is. I was starting to say before, the IRS shredded 10 million pieces of mail without opening it. And when they were confronted with that, their response was, well, the taxpayers weren't supposed to be sending anything to that address anyway that was.
So there could have been some checks in there.
There could have been a bunch of checks in there. Yeah. And they just shredded them out. So, and don't blame your local IRS people. I know people that work here in Port St. Lucie. They're good people doing their job. This isn't about that. It's, and they're in a situation they don't like because some of the old timers, they're kind of stuck with no support. The young people, they're wanting to do it, but it's no training.
Right.
And so if we can't collect taxes, what happens to the economy? Right. We could show them on the books.
We get bigger deficits.
Exactly. Right. It's the difference between accrual accounting and cash accounting for those that are in the business world. Accrual, you record the income when you're entitled to it, not necessarily when you receive it. Right. So I can show all kinds of profits, but if I'm not actually receiving the cash, I can go out of business.
There's no cash in the bank. Right.
I had a hospital one time when I was an auditor, that was actually making money. This was in Illinois, and this was when Medicare and Medicaid, in particular Medicaid, was so far behind in payments. And you'd file a Medicaid claim, and it could take a year to get paid on that Medicaid claim. Mm-hmm. This hospital had a situation where they had converted, their business was almost primarily all Medicaid, and it was almost all obstetrician type stuff, and babies and all of that. And they actually were profitable on paper, but we gave them a qualification, a going concern qualification, which means that we don't think they're going to make it a year. Mm. And they were making money, but they had on paper, but they had so much money owed to them by the government through Medicaid that they couldn't fund their bills. They couldn't pay their bills. So that's where we're at right now from a
administrative point of view.
Yeah, and an economic point of view within our government. We're pushing all these numbers through, showing all these budgets, and there's no money behind it. We don't have the cash behind some of this stuff.
Well, Mark, you've done a good job of describing the problem there. So I guess the next question is, what must we do to be saved?
Well, and that's where people are going to be surprised because, in my opinion, we have to start over. We have to eliminate the tax system completely and go to a different method of system. Something that it's kind of like, you know how when you're trying to reconcile your bank account and it doesn't reconcile,
I have
right?
that problem.
Right.
Yeah.
You can't get it to reconcile, right? So
I
what
thought
do you,
only I had that
no,
problem.
no, no. So what do you do?
CPAs have that
Yeah,
problem.
we have that
Oh
problem too.
wow. Okay.
And the
That
way
makes me feel better.
we solve the problem is the same way that economists solve the problem, and that is what we do is we close our account at the other bank, and then we open an account at a new bank and wait to see what clears, right?
Well, except the economist would assume a new bank.
Assume a new bank.
Yeah, we assume a new bank.
So in effect, that's right now. I believe that the system is so far gone that it can't be salvaged in the mechanism that it's in. And it's so complicated that the average person, I would say the average CPA that does taxes really isn't going to fully comprehend what's going on with some of this stuff. And there's no way you can know it all. So it's I think they have to start over again, and that's been proposed. There was a bipartisan effort years ago. A lot of economists supported it.
Yes,
So it
yes.
was something called the fair tax, and it's a national sales tax. It's really we don't have time to go into it now, but it's a program that they talk about simplifying. You would get rid of the IRS, you would get rid and not lose anything in terms of services because the states would be collecting the tax for
Right.
you. So I think that whatever it is, when an industry
It's a
changes,
tax on consumption, or maybe
yes,
like the
and
VAT tax or something.
right, yes, except it's not in parts; it's on the finished product. It's the first time you sell the product.
Mhm.
After that, no tax,
Mm-hmm.
and and to take away the regressive aspect of it. Um, every family gets what they call a prebate, which is a payment every month that would cover the taxes on their basic goods and services. So
Mm-hmm.
instead of giving them exemptions, and then all of a sudden we've got a tax law that's got all kinds of exemptions. People say, why don't we go to a flat tax? Well, we have a flat tax. What we have now was basically a flat tax when it was started. If you put down
never recognize it now.
No, you put down on a postcard how much money you thought you made,
yeah,
and then you paid tax on it, and that was it.
Yeah.
And so what happens with a flat tax is it makes people like myself and others rich because we're going to just redo the code again, and we're going to and so you're going to pay high prices, and the guys that got the money to pay the big time CPAs and attorneys, they're going to not pay the taxes, and they're going to rewrite the code they wanted, and so it is if you ever if you want to look into it, it's called fair tax. But this prebate then takes away that unfairness for the lower income.
Okay.
So now the lower income, and the interesting thing is if you buy used products. So let's say you got a choice. You can buy a brand new car or a 1 year old car, and you decide to buy the brand new car. You pay the sales tax.
Mm-hmm.
All right. But if you decide to buy the used car, 1 year older,
Mm-hmm.
no sales tax.
Has this been tried anywhere? This approach?
Not 100%. It is similar to the VAT tax, although the VAT tax is too hard to administrate.
Yes.
To administer, it's very difficult because small business has a hard time determining how much money they made at each stage of production.
Yeah. Mm-hmm.
So it's from an accounting standpoint, it's a mess. But yeah, I mean, there's parts of it. Nobody's ever implemented it completely.
Okay.
But one of the things that's interesting, people say, well, yeah, it's going to be like a 25% tax. But as we know, these taxes, whether they're Social Security taxes, estate taxes, employment taxes, whatever they are, income taxes, payroll taxes, they're all embedded in the products that we buy.
Right.
So as soon as you eliminate that tax, the price goes down. And I have had people say, well, why would anybody do that? The business is not going to reduce it. Yes, they are, because if there's competition, and that's where that has to be regulated. Right. If there's competition, they're going to bring it back to an equilibrium. So it's actually the solution, and it's been discussed by a number of people at a number of different levels. It was a grassroots program. There was a number of economists involved. There's a book been out for a long time. It's by a guy named Neil Bortz, and it's called The Fair Tax, FAIR tax. And and
Neil, Neil.
yeah, I think it's Neil. He was a
Mortz,
Bortz, Bortz.
I think I've heard of
He
that.
was a I think he was in Congress for a while. And anyway, and it has a list of all of the different. I mean, there were literally they had some of the top economists in the world. They probably called you and you were busy because you were usually busy all the time. I
Oh
tried to
no,
call you,
yeah.
so I'm sure you didn't get a call. But that's what happened with me too. Probably both of us. I was trying to get a hold of you,
I know, I
but
know.
anyway, but it was it's it regardless of whether it's that. The fact is, the only way you solve problems in an industry is disruption. You know,
Well, we've got that going on.
exactly. And
Yes,
that's why something's going to happen, right?
yes.
Anytime we have disruption in the economy, we're going to get a result. We may not like it.
But it's
You
going
know,
to
it could be
happen.
a depression, could be anything. We might not like it. And you're optimistic, so I won't say that word out loud.
Right.
But something like that's got to happen. The economy has to get fixed. And if we don't fix it, which we won't, and if we don't fix it by coming up with some solution like the fair tax or something that at least starts this over on a different path, then the alternatives, as you and I've talked a number of times, the alternatives are either um, a depression, not a recession, not a great recession, a full blown depression,
Depression.
or out of control inflation.
Yes.
That's your answer. The
Or maybe
socialist,
both at the same time,
it
unfortunately.
could be, and
Because Germany had that after World War One. So they had both.
yep.
Well, Mark, with the new tax laws, how does that affect me or other investors? If I buy stock and sell stock, if I buy bonds and sell bonds, if I get dividends, if I get interest, what do I need to be aware of now?
Well, you know, pretty much it's we've got favorable tax rates on capital gains.
And those are,
It's basically 15 or 20%. Actually, you can have, and from a planning standpoint, this is something that from a financial planning standpoint you need to talk to your planner on. You can have situations actually where a person has a fairly large amount of capital gains and they pay zero tax because there's zero tax on capital gains up to a certain amount of income. So if you don't have that income, then you don't pay tax.
but there are long-term capital gains and
There's long
short-term
term and
capital.
short term,
Okay,
right?
and what do I need to remember about that
Well,
now?
long term is 1 year, 1 day,
Yes,
and short term is
less than
anything
that.
less than that. Um, you have to be
And the rates are different.
yes. With yes, the long term rates are different. Uh, and and what you can offset, what kind of gains you can offset with losses are different. So only $3,000 worth of losses that you can deduct if you don't have capital gains to deduct them against. That's whether you have long term or short term. But one of the things with capital gains, especially long term capital gains, that you have to be careful of is what they call the wash sale rules.
Mm-hmm.
That's where let's say you want to hold it for a year, and so you
Sell
hold
it.
it for then you sell it and then you buy it back within 30 days, I think it is. Um, then that sale doesn't
Yeah,
count.
you got to wait 31 days or
Yeah,
32
yeah.
days.
So you got to wait a little longer
Now, have
before you
they
buy it back.
changed the rates on long-term and short-term capital gains? Are
Uh,
those rates the same, or have they changed?
they have changed. They've changed the rates on long term and on long term, short term capital gains. Uh, Generally, short term capital gains, you're talking about ordinary income tax rates.
Okay.
Um,
So if I'm at a 20% income tax rate, I pay 20% on my
right.
short-term gains.
Yeah. Or if you're
Or what about long-term gain?
long term are generally taxed at 20% is what we hear. They can be zero, and they can be 15%. It's all based on your income.
Okay.
And so so they look at your income when you're doing that. And so what you want to look at now probably is uh, I'm gonna you don't have a gain until you sell it.
Right.
So until you put that cash in your pocket, it doesn't count. So you can be happy, you can be depressed. You shouldn't be either of them because it doesn't make a difference unless you're selling,
Sell it, right.
right? what you're going to be.
You don't lose it until you sell it.
That's right. That's right.
Okay.
And that's an important factor.
Yes.
Actually, it's a very important factor. If I am taking losses in my retirement account,
it doesn't count.
Well, it doesn't count. You don't get to deduct it. And I have to make more money now to make the same amount of income because I can't put more money in. If I'm retired, I can't just. So let's say I lost $50,000 in my IRA. Well, if I'm retired, I can't put more money in that, right? So the $1 million worth of versus $1 million, and you have, let's say you end up with you're pulling a 5% return out of that, which would be high, but it'd be, so you're making $50,000 a year, right? So now let's say that you drop that down and you're making you drop down, you took a $200,000 loss. Mm-hmm. Now you're at $800,000, right? So now to make that same $50,000 with $800,000, you're up around, you have to make up around 6%, okay, right?
Right.
So now you're making, and when you go from making 5%, which is taking some risk anyway, right? But now you're going to 6%. You've now put yourself in a situation where you potentially have to take bigger risks, yes, to make the same amount of money.
Yes.
And so now you're going to have more of that where you go home every night, you check the stock market, you check it 6 times a day on your phone, you worry about what am I going to do if this market doesn't come back, and then you go, oh, thank goodness. And then you start it all over again the next morning. And if you're in that...
You do that too?
No, because I don't have any money. It works out easy. It's a lot easier when there's no money to worry about. But I will tell you, if this is just from a financial planning side, if you're retired and you're in a situation where you're checking the stock market every day, you're in the wrong stuff. I can just guarantee you that.
You're taking stuff.
Yeah, you're taking way too much risk. Now you might be able to get away with it because you got a little bit of background, but it's because most people that are retired, they shouldn't be dependent upon those capital gains to survive. Right. Yes, you still need to have some money invested so long term you can get some gains, but to be there every day and have to worry, I can't make my mortgage payment if the stock market goes down 3%, and it's great when it's up 6 or 7% like we are now, but it's horrible when you now.
The market's been strong recently.
Yeah,
but really wrong.
And again, that's especially in the IRA accounts, you have to be careful on losses because you cannot build that principal back up. If I have that same loss we were talking about, I could put $200,000 in if I had it. I can put $200,000 in an investment account and it'll build it back up. Or as that market is going down, I can continue to buy shares and dollar cost average, they call it. And, so then I, can get it back. But you can't do that in a IRA account.
Speaking of IRA, do you recommend the Roth IRA?
Yeah, no.
You don't.
We have to do it now. If you're over a certain amount, you have pension plans, 401k plans. Now you have to put it into a Roth. There's 2 reasons I don't favor a Roth. And almost all financial advisors I know favor them.
Yes.
And
those that I've talked to favor Roth, yes.
So here's the couple reasons that I'm not a big fan of. The first reason is that the whole concept behind a Roth is that you don't get a tax deduction now.
Get it later.
But later, when you pull it out, your taxes will be lower. That's the concept.
Well, you don't pay any, as I understand it, with the Roth, when I withdraw, I don't pay any tax on that withdrawal.
Right. But
I pay tax, I put after-tax money going in.
Right. But it's after-tax going in, and the concept is that when you pull that money out, you're not going to, because it was after-tax money, you're not going to have to pay tax on it. And that's going to save you money when you're at a higher tax bracket.
Right.
But here's the problem with it is that all tax planning that I know of is based on taking expenses now and postponing income. And with a Roth, what you're saying is, okay, I'll pay the tax now because I'm going to get more income later because I don't have to pay tax on those capital gains or on that income increase. But and this is why all the financial advisors like it, that assumes that your financial advisor is actually going to make money. How many people are going to actually be in a situation where they would have been better off taking the tax deduction now because they're in a lower tax bracket, or they didn't make the money in the Roth account?
Okay.
So that's one of the big reasons.
So you're gambling on a tax
Yeah,
situation.
and it's exactly opposite to what we normally do when we tax plan. We normally try to maximize expenses, maximize deductions, and then pay the tax as far down the road we can because we're going to push income down. We'll push it a year, we'll push it 10 years, we'll do 1031 exchanges and push it for our whole lives if we can. But the whole idea behind tax planning is tax deferral and getting as much deferred as possible. Ross, it's just the opposite. So that's the other. And then the other reason, the second reason, is a more practical reason, and we kind of touched upon it a little bit earlier, and that is that um, the system's messed up. Social Security isn't going to be able to handle everybody, right?
Yeah.
That money's going to have to come from somewhere.
Somewhere.
Well, it isn't going to come from the government. So where's it going to come from? Well, it's going to come from those people who put money aside. Mm-hmm. That have retirement money, right? Because those are the ones that are going to force off Social Security first, either by taxing them or by
denying the benefits,
yes. Right? Mm-hmm. So people aren't going to voluntarily go for that, and every congressperson and is going to get unelected if they propose that, right? If they start taxing, because I don't care how much money that you make, I still have people that make $1 million a year that come to me and say, hey, I paid tax on that Social Security. That's my money. I want it back, right? And so what I think is going to happen, and I've been surprised that it hasn't yet, is that at some point the the government, is going to have to modify the tax laws so that you have an incentive to pull money out of your IRA so that you can offset it.
Social Security.
And at that point, I think that every IRA account is going to become a Roth account because it's just right. You can't tax people on that much.
I've always felt that Social Security is actually double taxation because when I was working and I earned income, I paid tax on that income, and then out of that tax on income, I also had to pay Social Security. Now I get the Social Security benefit, and I'm paying tax again on the Social Security benefit.
Yeah, so absolutely.
I got tax going in, and I'm getting tax coming out. Yeah, not really fair.
No, it wasn't, and there is no, and that is what probably the people have the biggest gripe on, is that taxation. And here's the thing too, some of that, but they won't because Social Security is in such bad shape. But first of all, they should have invested that money. They didn't. They didn't. Oh. They invested it in all of the harebrained schemes that they have in Washington, but they didn't invest it in something that produced a return.
No.
Think about that. If we'd have taken all those dollars,
oh my gosh,
and invested them, think how strong our government would be. We would be no tax.
Just buy the S&P 500, buy the SPY or something. Yeah. Just let it go.
Yeah, you could. They could actually make it so no tax. You didn't have to pay any taxes because we'd have so much money. But and we wouldn't be worried about Social Security. We wouldn't be worried about Medicare. But they didn't, and so now that system is broken, and they're going to have to come up with an alternative. And so whether it's giving you some kind of benefit that you don't pay tax on your IRA, but you don't qualify for Social Security. In other words, you can offset your Social Security by taking money out of your IRA that you don't have to pay tax on.
Right.
See, I can see them do something like that, right?
Yes.
And so that would be the other thing that would really make sense is to basically start, and Trump started along that path. That's why I say, don't look at the guy, look at what he's doing.
Look at the policy.
The policy. Mm-hmm. The $1,000 for the kids.
That was a neat idea. I think that's good.
Right, because it starts them on retirement. And ultimately, what would be easy to do is to turn those accounts into IRA accounts, and have those, and that now you're building up those IRA accounts instead of Social Security taxes. So
speaking of that, I was very happy to see recently where there was a program enacted for people who don't have 401ks or IRAs, but can have an individual IRA, even though their company doesn't offer that. That happened recently,
Yeah, and you can have it, but you had to have earned income to be able to put money aside. So a lot of people were never able to, even though they wanted to fund their IRA, they weren't able to because
and now they can.
Now they can.
And I thought that was a good idea.
So yeah,
anything we can do to promote thrift and investment, I think is very good.
Yeah, absolutely. And so that area is going to get looked at, but in everything going forward, because when again, like I say, it needs something disruptive, and that's going to be changing.
We've got things right.
Yeah,
We've got it.
yeah, it's got it, and that's exactly where we're at with some of this stuff. So I I'm encouraged only because we live in really the greatest economy in the world, and,
Amen.
and we forget that sometimes when we talk about the greatest country in the world, because we talk about maybe what we do on a worldwide scale and all that. But what makes us the greatest country in the world is free enterprise, the
Yes.
right to make a profit, the
Right.
right to fail.
And property rights,
Right,
the protection of
exactly.
private property.
And
Yes.
you know, the right to fail is as important as the right to
Yes.
succeed.
Yes.
And
We learn from our failures.
right, right.
I have, and I'm sure you have too.
Well, you know, it's ridiculous with some of this stuff. You look at some of the messes that we've got into in the past, and you know, it's doing stupid things like, for example, um, you know, we have the government back private mortgages, you know, back Fannie Mae, have Fannie Mae and Freddie Mac back mortgages so they can be sold, right?
Right.
There was a market out there for those mortgages in the old days. You
Yes.
packaged those up and you sold them.
Yes.
There was usually insurance attached to them that you had
Yes.
to pay as part of
Yes.
the bond cost.
Right.
But the free market was
It
involved
was
in
work.
that,
It
right?
worked. Yes. It
And what
worked.
happened? Well, we basically made it such that because we wanted to encourage housing, you know, and buying houses, frankly, to people who couldn't afford it yet.
Right.
So we took dollars away from them, and you know, we had this situation where then the government became the sole source of funding. And so now when you start looking at other stuff, we talked about some of the problems with the tax code, we talked about Social Security, but the other issue is the only source of borrowing out there, loans for businesses, are government.
Yes.
Individuals, it's Fannie Mae and Freddie Mac,
Yes.
or Ginnie Mae, which is FHA,
Right.
or on the business side, it's SBA.
Which is why, again, the 30-year fixed mortgage is so dependent upon the yield on the 10-year bond,
It is
because it's all part of the same
that's the competition.
financial system of, you know, massive borrowing and massive lending, and you're going to pay the going rate. And right now, we're at about over 4.5%, I think, on the 10-year bond. The last I saw it,
Which historically would be a good rate,
which would be a good rate.
but not when you've.
But when you've got a 2 point above that for the 30-year fix, you're at 6.5% on the mortgage. Well, historically, that's not bad either. I paid higher rates
Right.
than that in my life.
I had 11%
Yes.
assumable Ginnie Mae
Yes, yes.
mortgage.
I have paid more than 6.5%. So I mean, the world doesn't come to an end because of that. But for some reason, and again, it's kind of a mass psychology or something that, you know, my gosh, we've got to get interest rates, mortgage rates below 6%. Well, hey, most of my life I paid
It
over,
wasn't.
you know, it
But
wasn't
here's
like
the
that.
thing: we have continued to forget that the cost of housing is not interest rates; it's what it costs you for
To
housing.
build a house.
The state of Florida is starting to recognize that, you know what, the cost of your housing is real estate taxes you're
Mm-hmm.
paying. The cost of your housing is
Insurance.
insurance you're
Yes.
paying. So if any of those get adjusted, right, then the value of your house is going to go up or down.
Right.
So for those of you here in Florida and for those of you elsewhere in the United States, I'm going to tell you a little secret. You've lost money on your house without knowing it. Because when we had 3% mortgages and you had a 3% mortgage on your house, right?
Right.
And now it went to 6%. When it went to 6%, that's a 3% increase in, interest rate, which is a 30% reduction in the
In
value
the
of your
present
home.
value, right?
Right?
I've had some programs on the inverse relationship between present value and interest rate, and it's very clear. For example, on bonds, if interest rates go up, the market value of a bond goes down. Then the same holds true for any kind of asset. If there's any kind of
It
a
would depend on
increase in
borrowing.
rate of return, any kind of income producing asset will go down in terms of market value, whether it's a stock, a bond, a house, an apartment complex, whatever.
Right.
And this is where some of the banks got into trouble because they had, say, government securities that were at a certain interest rate. And when that interest rate changed, for example, if the interest rates went up, the market value of those bonds that they had invested dropped.
Right.
And for some banks, significantly.
Right.
And this created all kinds of
And
problems.
and as I said, you haven't lost money until you actually
So
sell,
and they
right?
had to sell, and they had to sell at a loss.
And that's what's going on in the residential market. They're not having to sell yet because if I've got a 3% mortgage, I could rent the house out and probably cover that, right?
Right.
Because the housing
Unless
costs
I've got to buy another house.
right. Unless I got to buy another house.
Then
So
I've got a problem.
when you get to the point that, but even then, the banks will fund you keeping your existing home if you've got it rented. They won't take it off your ratios.
Right.
And so now you could still buy your new house. We used to have to do a bridge loan and they wouldn't do that. But now if you've actually got your home leased, it's an investment as long as you're producing income that's enough to cover the mortgage on that, which is a 3% mortgage. So it's allowing consumers to hide the loss.
Another thing I like is the idea of transferring the collateral. For example, if I have a house and I've got a 3% mortgage on it, and I want to go to a different house, I could just keep my mortgage and move it to the new house. In other words, just transfer. I know there would be an appraisal and so forth, but we basically are transferring the collateral from house A to house B and keeping the mortgage intact. And I like that idea.
Well, the interesting thing is that in the residential market, the appraisals the appraisals aren't being affected yet because the comps are still out there and nobody's selling anything really. Right. And when they do, they haven't necessarily had, there's a lot of cash deals going on right now. We're back to that point where there's a lot of people paying cash. So, you know, it's a big issue because people don't realize it's out there. And I think even some of the bankers and others don't realize how big it is and what an issue it is. And if we have a downturn in the economy that forces people to move, yes. Right? Mm-hmm. I.e., 25 and under. You've been working out of your house for a while. Now all of a sudden, right. You got to have a real job. Right. You got to go to some place. You got to get out. Now they may not have a house, but if their parents were paying for a house because they were renting a room from them or something, it may get to the point that they can't afford that anymore, and so that's going to cause that reduction in value is going to become realizable. Yes, and that's huge. 30% of our housing stock, if that's going to go down in value,
that's an impact.
It's an impact. Yes. And when we had the downturn in 2008 and 9, and it started actually in 2007, yes, was when it started. And I actually hit that almost on the nose. And within a couple, 3 or 4 months of it. And somebody asked me, well, how did you do that? And the way I did that was applied the appraisal technique that they use on commercial property for income. So what I said is no house is going to be worth more than what somebody could make from it off of an income standpoint. And I used that same income approach in the capitalization rate and everything. And it said, hey, this is what this house is worth. It's not worth this. Right. You've reached the limit. Right. And that's when they started collapsing because the buyers ended up all being investors, right? Mm-hmm. They were the ones that snatched up. But what did they pay? They only paid what they could make a profit on. And so that's when the housing market collapsed. And it wasn't until basically those prices came down and income and wages went up. Right. So yeah, it's an interesting, and that's what I think is the biggest thing. We're looking at some real challenges, and like I said, what Trump has done from a policy standpoint is and will produce really positive results, and it already has. The one big beautiful bill has worked out. The tariffs had worked out until the courts yanked them from him, and but still the threat of that still got people there. So but if all that goes away, if you always hear the saying elections matter. Yes. Well, I'd say this next election probably matters as much as any can. Yeah. Because we're at a situation where I'm not sure right now there are any Congress people or anybody in the executive offices that understand the finance of small business. And and we started to implement that. And small business is the driver of the recovery
Right.
or of the
That's where the
economy.
jobs are
That's where
created.
the jobs
Yeah.
are created.
It's the big firms that are laying off. Almost every issue of the Wall Street Journal I get, right on the front page there's an announcement. Some firm, Meta or somebody, is laying off thousands of people because
Right.
of AI or whatever.
Yep.
It's the small businesses that are generating employment.
Right. And one of the things that I always try to get people to focus on, because I actually had I, when I was in college, I had a class called taxes.
No.
No, but it was
In accounting, you had a class called taxes.
I did. I was taking a class outside my major.
Okay.
It was actually in economics.
Oh, okay. All
And
right.
it was tax. It was the economics of tax. My professor was Karl Marx. Literally, that was his name.
I love it.
That was his name, and I still remember. But it was how taxes work as it relates to micro and macro economics.
Right.
And one of the things that he made very clear is that businesses, the calculation of profit is different, um, for a from an economic standpoint than from a tax standpoint.
Yes.
There's economic income, and economists and accountants used to always argue who's right.
Right.
But the fact of the matter is there's an economic calculation of profits. But you'll hear people say things from time to time like, well, let's just tax the big corporations. They're making a ton of money. Let's tax the big corporations. Well, the fact is that corporations don't pay taxes. They can't pay taxes because if they did, their taxes are a cost for them. If they paid taxes, their costs would go up, their return on investment would go down, and nobody would buy their stock, right?
So they raise prices.
So they raise prices. As to the extent they
Somebody
can,
has
they
to pay
do.
it. Right.
And if they're a monopoly, they have no control over how high those prices go.
They can go.
Yep. And so that's why it's always, I always laugh. And you hear this come out of, really relatively smart people. Let's just tax the corporations. We'll get the corporations to
So
pay
like
tax.
Bernie Sanders.
Yeah, people like that. You can't tell me he doesn't know that. You can't tell me he doesn't know that taxing a corporation, particularly one that's a monopoly, but taxing a corporation isn't going to result in higher prices. It's going to, well, it's going to end up in higher prices or lower wages. He's going to make sure it's not lower wages because that's his base. He doesn't want them fired, right?
Right.
So he's going to push it into higher prices. And that's how socialism solves these problems is they inflate their way out of it till the currency isn't worth anything, and and then they go, and then things collapse and they start over.
I like that quote from Margaret Thatcher, who was Prime Minister of England years ago, that socialism is great until you run out of other people's money.
Exactly. And Merle, I guess we talked about a lot of this stuff, and I think this is really good because I think a lot of people don't really understand or are not exposed to some of this stuff. But it is important, I think, to understand that our country is great because of our economy. It's because the little guy has as much opportunity as anybody else. And you know what? I've gone through my whole life now. I'm 70, I'll be 71 this year. The ability to succeed and the ability to fail are what makes us great as a country. Not necessarily
every giant corporation we have started in somebody's garage or something like that.
Yeah.
I mean, or their college classroom. Where did Apple start? Where did Meta start? I mean, the founders dropped out of college to go to work.
I know. But and as they developed, they became more valuable.
Yes.
What gets me right now from a financial standpoint, what bothers me is a lot of the companies that we have that exist today sprung out of SPACs. They call them the special purpose.
Oh, yes.
And so they're hedge fund money that just went in, and so they didn't go through a growth phase that we got to experience the growth phase. They went into this just all of a sudden there's millions of dollars in their pocket.
And it remains to be seen how durable that approach is.
Exactly.
Okay.
Exactly.
It hasn't really had a major test yet.
Right. Exactly.
Well, Mark, on that note, we'll wrap it up. I want to thank you very much. This has been a very enjoyable discussion.
We always have.
Mark and I get together from time to time. Well, that concludes our report for this time, and be sure to the subscribe button, and we'll see you next time. And thank you again, Mark.
Thanks, bro.